Hello, everyone. Today, let's talk about something very important in the stock market world, expiry days. You might have heard this term a lot, especially if you are interested in derivatives. When you buy or sell a derivative contract, it doesn't last forever. It has a specific end date. On that date, the contract expires and you must settle your position. That's the expiry day. Now, you might be wondering about NSE and BSE, the two main stock exchanges in India. Both exchanges run derivatives markets, and each sets schedules for when those contracts expire. Think of it like a monthly metro pass. After the expiry date, it is no longer valid. Derivative contracts work similarly. In short, expiry day is the last day of life for a derivative contract, when positions must be closed or settled. Let's look at why these days matter, and what changed recently with the NSE and BSE calendar. Expiry days bring huge activity and volatility to the market. A massive number of contracts expire at once, forcing traders to decide, close, roll over, or settle. Think of it like the last day of a big mall sale. Shoppers rush and things get chaotic. That rush creates intense market action, sudden price moves, and unpredictability. Underlying stocks and indices can become choppy. Volatility is a double-edged sword. It offers quick profit opportunities and the risk of sudden losses. Collective F&O settlements can influence market direction for days, even weeks after expiry. Settlement helps determine a fair final price. Price discovery happens at expiry. Big institutions use expiry days to adjust portfolios. Their trades can ripple across markets. In short, expiry days are key to liquidity, price discovery, and market health. But they concentrate risk. Before recent changes, the system was simple and predictable. Expiry activity was concentrated on Thursdays. Monthly contracts for indices and stocks, plus weekly contracts, typically expired on the last Thursday. Traders planned all week, Monday, Tuesday, Wednesday, then a flurry of activity on Thursday. That concentration made Thursdays predictable but risky. All volume and risk piled onto one day. The NSE dominated F&O volume, making it hard for BSE to revive its derivatives business when expiries overlapped. This concentration set the stage for a calendar rethink. Regulators and exchanges looked for a safer, fairer model. So, historically, one big expiry day, Thursday, was the rule. Next, we examine the new, staggered calendar. Exchanges, in consultation with CB, revamped expiry scheduling to spread activity across the week. The idea: distribute risk and trading volume instead of concentrating it on one day. BSE shifted Sensex and BankX F&O expiry to Friday to capture volume outside Thursday. Traders can finish Thursday activity and then focus on BSE on Friday, giving BSE breathing room to attract trades. On the NSE side, FINIFTY weekly expiries were slotted for Tuesday. Bank Nifty moved to Wednesday. Nifty 50 monthly and weekly expiries remain on Thursday. Result: expiries are now spread across Tuesday through Friday. Smaller, more manageable volatility bursts across the week. Instead of one big explosion, we see multiple lower spikes, a calmer system overall. Traders must adapt weekly rhythms and strategies, but markets become less risky and more distributed. Next, the reasons behind this important change. The primary motivation: de-risk the market by avoiding a single day concentrating systemic pressure. One technical glitch or big news on a single day could cause chaos. Spreading expiries reduces that threat. Spreading expiry days also gives exchanges room to compete, crucially helping BSE revive its derivatives segment. Moving Sensex to Friday lets BSE capture volume without clashing with NSE's busiest day. Competition fosters better products, lower costs, and more efficient markets. Staggered expiries let traders free up capital midweek and reuse it for subsequent expiries, easing margin pressure. Distinct expiry days build depth and liquidity for each index, tightening spreads and improving price discovery. Long-term, a more mature, globally competitive Indian derivatives market. In short, reduce systemic risk, boost competition and liquidity, and enable smarter capital use across the trading week. To make this simple, imagine the stock market as a big weekly town market. In the old days, the town had a super sale only on Thursdays. Everyone came that day. Mr. Nifty, Thursday. Mr. Bank Nifty, previously also on Thursday. Mr. Sensex, also squeezed into the same day. Thursdays were chaotic. The town council, like SEBI, said, "This is too risky." So they gave each stall its own sale day. FINIFTY on Tuesday, Bank Nifty Wednesday, Nifty Thursday, Sensex Friday. The crowd is now spread. The market is busy all week, but less likely to be shut down by one event. Smaller stalls like Mr. Sensex now get customers on Friday, giving them a chance to grow. The new schedule made the market safer and more orderly across the week. So what does this mean for you, the trader or investor? For active F&O traders, the week has transformed. Instead of one high-stakes day, you now face multiple expiry days. More opportunities, more events to track. This can create serial opportunities, trade theta decay, or short-term option plays, but it also increases the temptation to overtrade. Example, trade FINIFTY on Tuesday, then Bank Nifty on Wednesday, Nifty on Thursday, and Sensex on Friday. A serial expiry week. But watch out. Trading every expiry can lead to overtrading and burnout. Discipline is essential. Staggered expiries help capital efficiency but require careful margin and settlement management. Know your broker's settlement cycle. For long-term investors who don't trade F&O, direct impact is minimal, but short-term volatility on multiple days can affect stock prices in your portfolio. E.g., financial stocks can move unusually on a FINIFTY expiry Tuesday. Don't panic sell on expiry-driven noise. Understand why prices move, stick to your plan, and manage margin. That keeps you steady across the new expiry week. Next, practical tips for navigating expiry days. Tip 1. Know the schedule. Mark each instrument's expiry day on your calendar. Tuesday, FINIFTY. Wednesday, Bank Nifty. Thursday, Nifty 50. Friday, Sensex. Tip 2. Manage risk. Set stop losses, avoid overtrading, and stick to a weekly budget. If you feel pressured after a loss, step back. Don't chase revenge trades. Tip 3. New traders. Observe a few expiry days on a demo account before trading real money. Remember, the last hour before settlement often sees a gamma burst. Be cautious in those minutes. Tip 4. Decide early. Close positions, roll over a day or two before expiry, or set a clear exit plan. Make sure funds are settled and know your broker's settlement times. Delays can derail your plan. Have a checklist. Expiry day, target, stop loss, rollover rules, and capital allocation. Plan ahead to avoid last-minute mistakes. Recap. Know the schedule, manage risk, observe then act, plan rollovers, and keep discipline. To sum up, India moved from a single Thursday expiry model to a staggered week. FINIFTY on Tuesday, Bank Nifty Wednesday, Nifty 50 on Thursday, and Sensex on Friday. This makes markets more robust and competitive. For you, stay informed, manage risk, and trade smartly. Knowledge is your most powerful tool. Stay disciplined, keep learning, and happy investing. Check exchange circulars and trusted sources for updates. Subscribe for more explainers. If you found this video helpful, please subscribe, like, and share our channel for more stock market insights.